Either it's the Facebooks, either it's the Instagrams, or something else. Actually, the Instagram has never been a problem. It's always LinkedIn, which of course is a Microsoft product, or YouTube, which is a Google product. So, anyways, thank you for joining in. Tonight is Tuesday night, and we are talking about the 1% rule in real estate. Let me grab my calculator, because of course my phone is right there. So, I usually use the calculator on my phone, but that's all right. I could use the one on the computer here, so that won't be a big deal. Let's see. Okay, so for this session today, when we talk about the 1% rule, you will definitely want to make sure that you have your calculator on hand. What that will allow you to do is actually to do some math here and follow along as we do this. So some of you have reached out to me on Instagram or Facebook or sent me an email to go ahead and review some properties. So this week I will be catching up on that. Next week I will be down in Texas again because we have a pool going in at one of our properties. So we'll talk about kind of the different scales. But essentially this year, one of my visions, one of the things that I wanted to start off with was really how to get started. And how to get started in the sense of how I got started, in the same way of utilizing the FHA loan as an investment product. And then what will happen throughout the next few months is that essentially you'll see a game plan. So as I mentioned in my previous videos, if all you want to do is live rent-free forever, meaning that you go in, you buy a property, you live there, you rent out the other units, and that's all you do, and you live rent-free forever, then great. This is definitely the information that's for you. After you get started with doing that, then if you want to scale, so if you're an individual that say, hey, I got my first property, I'm still working, I'm still doing this, now I want to scale this and do this as a business, what you'll discover is that there's many paths in real estate that you can follow, and investing really becomes a sport, an art, a game, kind of all of those things combined, right? And my wife and I earlier, we were coming back from downtown Miami, and we were actually discussing this, how there's a book out there, and again, I don't care if you agree with him or not. Donald Trump Jr. wrote this book. Donald Trump. I don't know why I said Jr. Donald Trump wrote this book, late 90s, I believe. It's called The Art of the Deal. If you haven't read that book, essentially what it talks about, I read it probably 3-4 years ago. Actually got to reread it just because most recently we've been at a few events and we're forming several joint ventures. So we're looking to structure deals maybe a little bit differently than we've done before. So anyways, in The Art of the Deal, one of the principles is how to put deals together. But more than anything else is just understanding that principle, that you're doing multiple things and it's not that one necessarily thing that is going to make you successful. You're putting multiple deals together, and once you get your first property, I think a lot of the mistakes that people make is that they just focus in that one asset class. And what ends up happening there is that you kind of get these blinders on, which is good for focusing, but then at the same time, you might be missing out on other opportunities. And what do I mean by that? What I mean by missing out on other opportunities is, let's say that you own a duplex, a two-family property, and the only thing that you have understood through watching some of my videos, through watching some of my content, is investing in these two-family properties. Well, let's say that an area comes up and you might be looking to buy, there's a 10-plex, a 10-unit property available, and it's like a smoking deal, and the owner is just tired and they are looking to sell, or they are looking to, give it away for somebody else to manage and get some income from it, whatever the scenario is, right? Unless you're open to it. So if you have these blinders on that all you see is two family, two family, two family, you're not seeing anything else. You look in here, two family, two family, two family, 10plex over here, doesn't matter. I'm focused on two family. What ends up happening is that you actually lose opportunity. So in the art of the deal, what you'll actually find is that at the end of the day, every single investment, every single transaction that you do has its own criteria, right? But sometimes we are so focused, and this happens across the business world, the sports world, whatever. We're so focused on this one area that it doesn't allow us to really scale or grow or even get access to other opportunities because we're so focused. Now, the hindsight to that is don't go so wide that you're like, oh, and this happened to me probably in 2018, where it was like, oh, well, I'm doing real estate, so let me combine it with a solar opportunity. And actually, because I'm doing real estate, I have some people reaching out to me. Let me join a multi-level marketing company that also does credit repair. Oh, and now because I'm interested in marketing and I'm doing things online, let me also start to venture more into the marketing space and get some people signed up for an affiliate marketing product. Well, now because I'm in affiliate marketing and I'm also doing marketing, let me see how I can offer a product that also becomes another avenue. So you see how for me, when I was thinking about it, I had the best of intentions, and what I actually did was, just that. I had the best of intentions, and I looked up whatever opportunity I wanted to do, and then I figured, okay, what can I add for that to be parallel to it, right? So like real estate, credit repair, earning more income, affiliate marketing, all of these things were kind of parallel and in line with each other, but I actually went too broad. So anyways, when you're looking at real estate as a whole of an investment strategy, sorry, I'm just going to put this to charge. When you're looking at this as an investment strategy, don't stay so focused, so blind that you're only looking at one product, and don't go so broad that you're like, oh my God, I want to do condo investing, and I want to do single family, and I want to do fix and flip, and I want to buy multifamily, and I want to do an FHA on multiple properties, and then I want to get into industrial, and then I want to get into commercial, right? Like that's broad. You can do that when you're at a certain scale, but in the beginning it's like, okay, this worked for you. You got your first property, you bought it with an FHA loan, and now a year or two has passed and you're ready to continue investing. So you might be in that game. And then so initially, as I was saying, this year started off with me wanting to share how I got started. Then the second step is, okay, how do you increase now that you have 1 unit, now that you have 2 units, 4 units? How do you increase in your local markets and also going national in other markets, joint ventures, etc.? And then kind of the final step, the third customer, if you will, or the third person that will want to watch this is, okay, I might have 4 or 5 units. How do I continue increasing joint ventures? What am I doing to calculate my cash on cash returns? Am I really getting the asset protection that I need? So it kind of becomes this higher level thinking. And then at the end, kind of the pinnacle of everything is like, okay, well, great, you've built this $10 million portfolio, $100 million portfolio. What's next, right? And that's where you kind of need to be at the next level to, where I've spent the last 6 months really networking with people that are multi-billionaires, multi-millionaires in the space, and their thought process of portfolios and the returns is completely different. So again, we'll get into that. But tonight, what we're focusing in is the 1% rule. So if you're new to real estate, or maybe you've had some exposure or you've seen some other things, you might have heard that there's this rule, right? Or this mythical figure called the 1%. And the 1% rule in real estate, what it means in its most basic form is that a good deal, right? Whatever you want to call, quote unquote, a good deal, but where the markets is at. Now, when I say markets, is private equity companies and publicly traded companies, they buy real estate portfolios in order for them to, diversify their investments. So they use this, Wall Street came up with this and they said, hey, we'll use this 1% rule and that will give us a cap rate of a good, quote unquote, return that we can offer our customers. So this 1% rule, even if you're buying your first deal, can still apply to kind of determine and say, hey, is this a good deal? Is this a really good deal? Or is this just market rate? Or is just, the numbers are way too high? So again, you'd want to have your calculator out for this. And the easiest way, let me see, I was looking for my calculator earlier and I couldn't find it. Give me 1 second. Oh, of course, I had it up on my screen. Here we go. So the easiest way to figure this out is, let's say you're looking at homes, and you're looking at homes for $500,000. And that's probably going to apply to, 90% of the United States right now. So you see a duplex for $500,000, or you see a threeplex for $500,000, or you see a fourplex. Again, unless you're in Arkansas or some other parts of the Midwest, I think a fourplex in the Northeast and anywhere across the East Coast, you're probably roughly $150 to $200 per unit. So you're in that $600,000 to $800,000 range. So what does this mean, the 1% rule? So let's just take this $500,000 sale price, right? You take $500,000 and you multiply that times 1%. So if you put in your calculator 500,000 times 0.01, it will give you $5,000. What that means is, in general, again, very, very general, if your property brings in rental income, so what you get from your tenants every single month equals $5,000 on a $500,000 investment, generally speaking, you have a 6 to 7% cap rate. Now, cap rate is just at the rate that your money multiplies. So anyways, that's a general good rule of thumb. So when you're looking at that $500,000 property, just see, hey, every month the first floor is rented out for $2,000, the second floor is rented out for $1,750, that's $3,750, and then the third floor is rented out for $1,000, that's $4,750. So you're very, very close to that $5,000 of rental income per month in order to equal the 1% rule. Now, if you're just looking at your first property, you can actually reverse engineer this. And what I say reverse engineer is by figuring out exactly, how much rental income you can have, what's kind of the maximum sale price that is. So let's say right now you live in Massachusetts, right? And I'll just talk about this because my cousin has been interested in buying a home. So he's looking at a few areas. And I'm going to make a special video for you regarding the homes that you sent me, even though those homes are already off the market. Doesn't really matter. You could see exactly where we're at. So in Massachusetts, I know what the market rent is. 1 bedrooms are going for $1,250 to $1,500. 2 bedrooms are anywhere from $1,500 to $2,000. 3 bedrooms, $2,000 to $2,500. So understanding these numbers, we could reverse engineer. So let's say we were looking at a threeplex. Let's say you have, just to make it easy, let's say every single floor is the same. It's 2 or 3. Let's say it's 3 bedrooms, all the floors, and each one of the units you could rent it out for $2,000. Just simple, straightforward numbers. That's $6,000. If you took $6,000 and divided it by 0.01, so you're doing the inverse, it would give you a sales price of $600,000. So what that means is when you're looking on the MLS, when you're working with your real estate agent, if you see a property and you read the description, most of the descriptions, sometimes they'll have a per unit breakdown, or they'll actually say first floor rented at whatever, $2,000, second floor rented at $2,000, floor, month-to-month lease, rental at $1,750. You can add up those numbers really, really quick. So in the previous example, like I said, we assumed it was 6,000 total. And then based on that, you divide it by 0.01. That will give you your sales price. Now, let's say that home, because of just where the market is at, things are much more expensive, inflation, blah, blah, blah. Let's say that home is worth $700,000. Is it still a good deal? The answer is yes and no. And the reason is two things. The first thing is when it's a pure investment, right? Detach from this emotionally 100% and just look at it from a numbers point of view. If today the market, right, the market is at a 6% capitalization rate, and you buy something at a 6% capitalization rate, and a critical life event happens, you have a horrible accident and you can no longer work. Somebody dies, a child of yours dies, and you are just like, withdrawn from society. You, pick up a bad habit, and now all of a sudden you're on rehab or whatever, right? Again, worst case life scenario. If you bought that asset today, do you think that maybe 30 days from now, 45 days from now, somebody would probably pay you the same price that you paid for it? If the answer is yes, then okay, maybe, you can exit out of it. If the answer is no, you overpaid for that property because the market is at 6% and you're buying it at, a 5% or a 4%. So remember, in real estate, it's actually the inverse. The lower your cap rate, the more expensive your price is. So anyways, in the 1% rule, if you're buying a property that's not even close to market value and you're overpaying for it because that 1% rule doesn't work out, well, from just a mathematical standpoint, maybe you're better off just holding up a little bit, because then if you have a life critical event, most likely you're going to lose some money, or you won't be able to sell your home as quick, or you'll have all these pressures. Or there's other investments right now that tend to have better returns, so an investor might not buy from you. So again, start to think of this also as an investor. If you were just purely investing your money and you look at one deal over here and you're at, let's say you're at a 6% return, and then you're looking at a deal over here and it has an 8% return, what's going to get you better money? The 8% return deal is better than 6, right? 8 is bigger than 6. What that means is if you invest $100,000, you get $6,000 a year over here, or you get $8,000 a year over here. If it's purely mathematical, if it's exactly the same thing, exactly the same product, it's in exactly the same condition, right? Those are the two things that you're weighing out. So think of it that way. So that's kind of rule number one is you kind of want to be at that, because then you're like, well, if something really, really bad happens and I just had to sell this thing tomorrow, could I still get what I paid for it? Or am I buying above this 1% rule that now is just like no investor would even think about this, because also investors are savvy. They know that there's deals out there. They're actively sourcing for deals. So maybe this isn't the best deal and they might wait, right? You learn about delayed gratification. We talked about this in one of our previous videos, where it's short-term sacrifices for long-term results, right? You're going to buy this FHA 2-unit, 3-unit, 4-unit property, and in a few years, you probably move out of there. You either resell it or you keep it as a rental. You buy another one. You're creating that portfolio, but you're living either rent-free or almost rent-free. So now let's go back to the 1% rule. So we looked at, let's say that we're keeping the same example, the threeplex, right? The threeplex costs $600,000. That $600,000 threeplex is going to bring us roughly $2,000 per unit for rent. So now, what you want to do is you want to go ahead and do the math. So there's plenty of websites. Again, I talked about Zillow last time I was here. So if you go on Zillow and you type in wherever you are, there's a calculator, which I'm pulling up here. And there's other websites that are out there. One that I really, really like, I think it's called Investopedia. And then there's a couple of other ones that are fairly good. So let me pull up the calculator here on Zillow. Monthly cost. Okay, so I'm pulling it up here right now in order for us to do this together. Here we go. So $600,000 is our home. We are putting 3.5% down. It's 30 years fixed at 6.5% interest rate. So, again, roughly on that, the principal and interest is $3,640 per month. And then you have all your other expenses like your mortgage insurance, property taxes, homeowners insurance. If you have any HOAs, which again, you want to stay away from in your initial purchase. So again, that $600,000 home, your first cost is your principal and interest is $3,640, and then after you add in your property taxes, etc. On this example, you're about $5,400. So again, going back at the rent, right? And we look at $600,000 home, 1% rule is $6,000 per month. You rent out the first floor, you rent out the second floor. Now you're living on the third floor. Because remember, I said the third floor was bringing like $1,750 and it was month to month. So you have $4,000 coming in, but your monthly mortgage payment is $5,400 between your principal, interest, homeowners insurance, everything else. So now you have to come out of your pocket $1,400 per month in order to pay that. Some of you might say, well, that's not really a good deal unless you are that individual that is currently living in a 3-bedroom and your 3-bedroom is about to go up to $2,500 because water and sewer went up, taxes went up, whatever, and the homeowner is increasing the rent because of, where the market is at. So if you're going to be paying $2,500 and now you could pay $1,400, you just saved $1,000 per month. You see how this works? So again, that's kind of the principle of how you would want to do this. And when I break down later on this week some of the properties that my cousin sent me that he wants me to analyze, I'll show you exactly what to do. Now, here's a ninja trick, right? And this ninja trick is probably would only apply to about 10-15% of the people. Some states, when you look at income, right? Some states, they have what's called income tax. So for every hour that you work, for every paycheck that you get taxed. The state sends you an income tax. In a certain area in Massachusetts, there's a lot of people that actually work in Massachusetts and live in New Hampshire. Because they are full-time residents of New Hampshire, what that allows them to do is they're actually saving money on a Massachusetts income tax because they are New Hampshire residents. So, in a scenario, let's say you were making gross $50,000 a year, or $100,000 a year. Well, let's use $50,000 because I know the tax bracket is about 20%, 25% or so. So in Massachusetts, if you're making about $50,000 per year, you're probably paying about 25% of your tax margin is probably about 25%. So what that means is that after you get all your exemptions, all that stuff, you're probably paying anywhere between $2,500 to $5,000 of taxes, right? And again, I'm not a tax accountant. My wife is a specialist. I get the basics of it. But again, if you want some help and advice, go and check out with your tax accountant and have them verify what I'm saying. So you make that $50,000 salary in Massachusetts, you're going to have to pay Massachusetts income tax. That income tax, let's just say, is $2,500. Now, all of a sudden, you make the same income, but you move to New Hampshire, your income tax is zero. So you just reduced your tax liability $2,500. Now your taxes, because in New Hampshire the property taxes are probably higher than Massachusetts, your net number is probably going to equal out zero. Because yes, you're paying more in property tax, but you're also taking more money home because your income tax doesn't exist. So again, this applies In very few scenarios, people that live right on that Massachusetts, New Hampshire border where there's no income tax. There's other states that have no income tax that you might be in very similar scenarios, and you can check in with that. But again, on the basis, kind of have that 1% rule in mind, right? What's the sales price of the home? And using the 1% rule, how much monthly rental income should it bring in? So again, if you're buying a $400,000 home, a duplex, now again, watch how this kind of applies all over the board. If you're buying a $400,000 duplex, you should be able to get $4,000 a month in rent in order for it to be a quote-unquote good investment for what Wall Street or those private equity guys would be considering an investment that they would buy, right? So $400,000 home, $4,000 a month. Now, if one of the units is bringing in $2,500 and you live in the other one, $1,500, obviously that doesn't apply. But if you moved out of there and now you can rent it out for $2,000, one unit is bringing in $2,500, the other one's bringing in $2,000, you're at $4,500, you're over the 1% rule, so you're actually doing pretty good. So again, when you look at properties, this 1% rule, what that actually allows you to do is kind of filter out things quicker, right? So if it meets or is, let's say you're, because of where the market is at, because of where everything is at, you're just like, look, my rent is about to go to $2,500. And I know that if I buy a duplex, I would be paying less than $2,500 out of pocket. So by buying a property, I'm actually saving money versus what my rental market is, right? So follow me here. So if that's the scenario and you see a property come up and you're like, hey, I've been looking for homes for a while. This duplex just came up. It's $450,000. But then you look at it and it's like, wow, one of the units is rented out for $2,250. The other units is rented out for $2,500. That's $4,750. Let me look at this deeper so I can make that evaluation. Same thing. If a unit comes on the market for $450,000 and it's like, well, one of the units has a long-term tenant that's been paying $1,000. The other unit is a month-to-month tenant that's paying $1,750. I mean, you're at like, let's see, what's that? So, $750. So you're at $1,000, right? Plus $750. That's $1,750. So if you were to take that $1,750 and divide it by 400,000, right? Times 100, that would actually equal 0.4%. So you're like 0.5% rule right there. What that's going to mean is that you're actually going to have to come up with a lot of money out of pocket in order to cover your, mortgage payment or your rental payment. So you're going to be paying more in rent than what you're paying right now. Now, of course, there's exceptions to everything, right? Maybe this property is in a zoning district that is about to get rezoned, or it's already been rezoned and the property values are going to go up. Maybe it's the school systems are changing and now they went from a grade C school to a grade A school, and now more people are looking to move in, and the market value for the rental properties there are actually much higher than that. Maybe that's the scenario. Maybe this property is really distressed. Of course, that's going to be an issue when you look at FHA loans. Maybe that property value is kind of distressed, and because it's distressed, you might be able to you might be able to fix it up and get more money from it. So again, from a first property, that might not be what you want to do. Number one, because you might want to get the experience. But again, maybe it does qualify for FHA because it doesn't have any peeling paint. The screens are broken. Things structurally are, falling apart. The electrical is working. The gas is working. Everything seems to be working okay. But again, there are some issues on what is happening. So with that being said, what you want to do is kind of have that eye for it. If you want to be that future investor, maybe that's the way that you go. And that's what I did. I bought the ugliest property on the street that had potential, but it would qualify for an FHA. But again, I personally had some firsthand construction experience. I personally was already working in that field. I knew what the potential was, and I didn't mind some hands-on, and it qualified, right? But for you, some of you that are working, two jobs, or that are working, many more hours, that might not be the path, because you might not be so handy. And again, buying a fixer-upper, again, this is the second part of this video of how this 1% rule can really, really go bad on you if that's all that you're considering. The 1% rule is just one measure. In real estate, what I found is you probably have hundreds of different things that you can consider. And when I'm all said and done with my book, one of the chapters will be talking specifically about that. Now, in my book, I'll actually have it with the same categories that we spoke about earlier today. It'll be the same way. The first one will be, hey, these are kind of the basics. This is what you want to look into. This is how you want to make sure that things are working out. And then as you get more advanced, we'll get into more advanced topic. Because again, if I tell you the amount of shit that can go wrong in real estate, between roofing and fire damage and people slipping and falling on your property, water damage, bed bugs, your furnace is going out. It's a fucking coincidence that every time your furnace goes out, it's never in the middle of June. It's always in the middle of February, when it's the coldest day of the year and the plumber can't get there until the next morning. That's when your furnace goes out. And guess what? You have to call a second plumber, a third plumber, and the guy who can get out there, the same thing that would have cost you, $1,000, $1,500 to fix, is now all of a sudden a $5,000 bill, or even more than that. It could be an $8,000 bill because you had some freezing pipes, all of that stuff. You got disgruntled tenants, all of that shit. Again, talking from experience. Now, there's certainly things you can do from a preventive maintenance point of view, so you're minimizing your risk of that happening. But again, things break. It's a mechanical issue, and you can plan for it, and you can kind of have everything ready for it. You can do the maintenance for it, but if it craps the bed and it just messes up on the last day, it is what it is. You can't do much about it. So again, going back to the 1% rule, right now, this part of the video is probably, I'm going to go into your second and third category. So if you don't own a property, go back and kind of re-watch everything that I said, and go back and watch maybe my last week's video and take a look at some numbers. Now, if you already have 1 property, 10 properties, whatever, right? One thing that you might consider that I'm seeing a lot of right now as a real estate investor and also as a real estate broker is a lot of investors have gotten comfortable through COVID. And what do I mean by that? COVID put a competition on every single real estate property out there, especially in the rental market. The rental market in most areas just continued to go up and up and up and up. And because it's gotten so high, you're like, well, I can't really move, or my tenants, I'm keeping them at this 80%, 75% of market rent. They can't really move. And again, tenants are afraid because now if they move out, they can't find a better place. The place that they're at is not so bad after all. So all of that. And it's like, I've seen some units where it's like, damn, that apartment is falling apart, but people are going and renting it because there's a housing shortage, right? It's difficult to find properties that might be affordable. Now, there are people that are selling with this 1% rule, properties that are bringing in 1% of monthly rent. I recently looked at an asset, a portfolio that it was actually 2 buildings. It was going for $8 million, about $4 million each, and they were bringing in about $80,000 a month for each, $80,000 a month combined, so $40,000 for each property. So that will put you in this 1% rule. But then I started doing more due diligence. On a numbers point, it seemed like an okay deal. Nothing really like super wow, this is the best deal I've ever seen. But then I started looking. The roof, although it's not leaking, just from Google Earth, you could see that it's been patched. And even in the disclosures, some of the receipts were, hey, the homeowner has patched this roof most recently in 2020. And I mean, you could see like gray, black, like charcoal, and you could just see it's a flat roof scenario. So those are historically bad. But again, if you look at this and you understand real estate, I mean, it's like this roof is, you're probably going to be looking at $100,000 of capital expenditures to replace this roof sometime in the next year or two. So if you don't take in that account and you're just buying on the 1% rule, you're screwed. The next thing we started looking into was the AC units, because this was in South Florida, you know, the AC units. And I mean, this property was all over the map. It had number one, it had 2 units that had no AC. So they actually had these standing things. Let me see if I can pull up the listing real quick and I'll share it with you. So actually, I'll do another video with that. So they had the standing units where you could stand it up and you take the pipe outside and it's supposed to blow out all the hot things. So again, 2 of the units didn't even have AC, and for whatever reason, I think what ended up happening? I think what happened was it had railings. You know how they have the security railings on the windows, so you couldn't put a window air conditioning, so they put one of those standing ones. It was really, really bizarre. So that's another thing, you know, 2 units didn't have any AC units. The other ones had a combination of window AC units, which were all over the map. And then the other, I think there was 2 units that had HVAC systems, but they were from like 1970 original. So just really, it was really, really like cut up and really misunderstood. So it's like, well, now I know I need a new roof in the next few years. The HVAC systems are a mess. And then we got to look at the electrical. Now the electrical, so this property was like 2 additions, right? So the original building was a 4-plex. Then they built 2 units onto it, and then they built 2 additional units onto that. So it was an 8-plex going for $4 million. So, you know, you're looking at $500,000 a unit. So you'd be like, oh, well, you know, that is really, really expensive. But at the same time, it was because of the location on the beach, it was bringing really, really good rents. But then we started looking further into it, and I mean, the electrical is all over the map. Number one, it had fuses in one of the locations. Number 2, it had 100 amp service on one side, and then the other building had 200 amp service. And then number 3, a lot of the areas were like, oh, utilities are included. So that person that was paying, you know, $1,700 a month for that studio had the utilities included, but when you subtracted electrical and Wi-Fi, because you couldn't separate the utilities because it wasn't separately metered, all of a sudden that $1,750 in rent is more like, you know, $1,200 in some scenarios. So that came up. And then just in general, the property itself was, you know, it was decent. It was nothing like phenomenal, like, wow, I'm walking into a $500,000 apartment. You know, just early 2000s renovations, Formica countertops, you know, your standard double sink, white appliances, just something that you would walk in and be like, okay, you know, I could rent here. It's okay. It's not trash. But again, the numbers that they were selling is like, dude, there's no way. And then when we started looking into it, they had actually disclosed information wrong, because once we signed the due diligence and we signed the non-disclosure agreements, what we actually found out is that more than 50% of the income that they were getting was from Airbnb. So that's great because the numbers are up there, but this area, it wasn't licensed to be an Airbnb. So that's a huge red flag, because again, how the hell are you going to get financing for it? And number 2, if you can't continue operating at an Airbnb and get this 1% rule on an $8 million asset, now you're no longer in that 1% rule. You're like 0.5%. And then when you take into account all of the maintenance items and all the deferred capital expenditures, I mean, you're just gone. So that unit's been on the market for over 6 months. It will continue to be on the market for the next 10 years at the price that they're trying to sell it for, and it makes no sense. But again, start to look at this stuff. If you're already a seasoned investor, don't just go in on that 1% rule and be like, hey, this is a 1% rule, I got to jump on it, whatever, you know. Again, as you get more experience, you'll actually want to buy things at a 2% rule, at a 3% rule. One of the reasons that we're actually shifting, and last year we sold some of the units that we had, which were, you know, duplexes, and we got into an RV parks, is because mobile home parks and RV parks are bringing in, you know, 15-20% returns versus, you know, the multifamily stuff that we were getting single digits, 6 to 8% returns. So, you know, as a seasoned investor, see where your portfolio's at and be comfortable with looking at other assets. Don't get stuck on this, you know, I need to buy a multifamily 10plex or 20plex or 40plex, because that's what I was doing. If you're really looking for a return, a higher return, you know, maybe another asset class is the way to go. So that's how I'm going to actually wrap up this video. If you have any questions, let me know in the comments here. I'm just taking a look, seeing if we got any comments on Facebook or YouTube's or LinkedIn. Okay. Doesn't look like there's anything there. Or Twitter. Let's see what we got on Twitter. Nothing there. Anything on Instagram? My Instagram folks. Let's see. Nobody there. Okay, so again, if you want for me to answer a certain question, just DM me. I do clear my DMs every single night. A lot of it does go to spam, and my VA catches that and just, you know, lets me know that we need to respond to it. So that's kind of the 1% rule. Again, just the basis is if you're buying an income producing property, and again, it's bringing in, it's a $500,000 property. You take the 1% rule. What you want is, in general, monthly gross income. So whatever money you're taking in, it equals that 1%, which is $5,000. Very basic. It's just a metric. If it's a little bit less, if it's a little bit more, don't go crazy. Don't lose your mind. There's other factors that we need to bring to look into. And next week, what I'm actually do is next week I'll actually put that in play, and I'll actually come up with a spreadsheet of things to look into. And then stay tuned. Next week I'm going to be out in Texas, as I mentioned, and I'm still going to do the live stream because I'm dedicated to doing this year. So I'm still going to do the live stream, so pay attention to that. I'll show you what's going on in Texas over there, why I decided to go there, and some of the systems that we're putting into place in order to continue scaling. And actually another asset, while I'm there, we're going to be, as I'm driving there, I'm going to be looking at 2 other assets that we're interested in. And then, you know, we'll go from there and I'll share those with you. So with that, hopefully you enjoyed this video. Comment, like, share, subscribe. Send me your questions. I will respond to them, even if it takes me 24 to 48 hours, just because we are getting more responses. But I do see everything. I do respond to each and every one of you individually. So thanks for your time, and I'll see you on here on the next video. So let's end it here as well. Thank you.